Well, I have created a simple system for myself to figure out whether a business is improving or not over a period of time. And the best place to look at when we are talking about a business is improving or not, the best place to look at is the profit and loss account statement of the company, the most simplest of all statements that the company releases every year. So, how do I look at the profit and loss account of the company? That is what I want to discuss in this video. So, the first thing that I look at is the revenue from operations. I only want to look at the revenue that the company is generating from operations. I exclude other income from this. I want to know how much the company is making by selling a product or a service. So that is one thing, revenue from operations. From that, I reduce the cost of goods sold or cost of providing the service, whatever. So if it's a manufacturing company, it's cost of goods sold. And if it's a service providing company, then it is the cost of providing the service. So I reduce that from the revenue from operations. What I get is the gross profit of the company. The higher the gross profit margin, the better. I look at past 10 years of history of the company. If the gross profit margin is improving over a period of time, that tells me that the company has got pricing power and the company is not affected by competition and the business is improving. At least it has improved in the past 10 years. So that's the gross margin, gross profit divided by the revenue from operations. Then there are a couple of expenses that I deduct from the gross profit. One is depreciation on fixed assets. Second is a lot of expenses that I club together in one bucket, which is selling, general, administrative, research and development. These are the 5 things. Selling, general, administrative, research and development. These are the 5 expenses that I put in one bucket and remove from the gross profit. SGARD and depreciation. These are the 2 expenses. If we remove from the gross profit, what we are left with is the operating profit of the company. So now we can calculate the operating profit margin of the company if we divide the operating profit by the revenue. The higher the operating profit margin, the better. If we see a trend where operating margin is growing over a period of time, at least the past 10 years, that means the business is improving. From the operating profit, what I reduce is the interest expense. Let's say the company has taken on some debt. Generally, I don't look at leveraged companies, but if the company has little bit of debt, it will have some interest expense. So from the operating profit, I reduce the interest expense. So what I'm left over is the pre-tax operating earnings of the company. Pre-tax operating earnings of the company. It's a very important number because I compare this number with the equity of the company. I compare this number with the invested capital of the company. I also compare this number with the market value of the company. So basically, if let's say the market value of a company is 4,000 crores and pre-tax operating earnings are 400 crores, in that case, your pre-tax operating yield of the company is 10%. So if fixed deposits in a bank are offering me 5% and if this company is offering me a 10% yield and that too a growing yield because we are investing in a business, then it's probably an undervalued company. So that is why pre-tax operating earnings is very important. Now from pre-tax operating earnings to this, we have to add the other income. Remember when we looked at the revenue, we excluded other income because we only wanted to see revenue from operations. To the pre-tax operating earnings, I add the other income. What I get is the profit before tax. From the profit before tax, I reduce the taxes and then what I have left with is the profit after tax. That gives me the net margin. So the profit after tax divided by the revenue is the net margin. Again, if the net margin is improving over a period of time, that means the management of the company is doing something right. So the process is very simple. We just have to look at these 4 or 5 items: the revenue, the cost of goods sold, selling, general, administrative, research and development cost, depreciation and interest expense and other income. That's it. These are the only 5 or 6 things that we need to look at. And if we look at these numbers over a 10-year period for a particular company, and then compare these numbers with other companies in the same sector, then we will know which company is a better company in that particular sector. So analyzing the profit and loss account is a very simple exercise that any retail investor can do to figure out whether the business is improving or not. If you find a business where the gross margin was 40% 10 years ago and now it has come down to 23%, you have a clear signal that there is something wrong. Maybe the company has lost pricing power, maybe the raw materials prices have increased or whatever. Something is wrong with the business. But if you find a business where the gross profit margin was 40%, now it is 63%, you know that the company is doing something right. So look at the profit and loss account statement. That gives us an idea as to whether the business is improving or not. Thank you so much.